Hello, so today we are going to be going over the driver framework with our CAP-M um, cost of equity. So let's start with our driver framework, which is define, represent, implement, or define, represent, implement, validate, evolve, reflect. So this is our doc for the day, and we're just going to be going off of that. So let's start with our first D, which is define and discover. We had our task open up, so what we got from that is select companies with different profile risks, what drives their beta. And so we want to put ourselves in a venture capital firm. We're evaluating 3 potential investments, and it wants to know the required rate of return using the capital asset pricing model. And so it has the insights about the companies, the 3 companies that it gives us, and it also wants one on like a small business. So we chose OpenAI for this example. So first, let's just go over the basics. Company A is Cloud Tech, which is a software startup. Its beta is 1.8, no debt, and it's just competing with the established tech firm. So that's probably why we have our beta. It's a good time to define that. So the beta is kind of the risk analysis, if it's more risky than the market, or if it's just less risky, or if it's right at it. The closer it is to 1 is the more standard it is to the market. So then we have B, Company B, which is our regional bank corp. Our beta is 0.9, traditional banking operations, stable but slow growth, which is why this beta is really close to 1. And then Green Energy Utilities is beta of 0.5, regulated utility company, and it's predictable cash flows because it has a low beta. It's not volatile. It's not bumping up and down. And just our market info. We have our risk-free rate for the Treasury, which is 4.5. Historical market risk premium is 6, and then the S&P 500 is 10.5. So, and then we have these additional context and questions, but we'll get to them at the end there. So we're now moving, now that we know what we're dealing with, we're going to represent it. So we're going to look at a line, which I attached it here, but I'll just go into this Google Sheet. So we have our data points. This is our risk-free rate, and then this is just the market rate. Then we have our company C, Green Energy, company B, Regional Bank, company A, Cloud Tech. So I made this graph. I put them all in here and made this graph, and we have our bolded points at 4.5 and a beta of 0 for our risk-free. Then I have 7.5 and 0.5 beta for our company C, and then 9.9, as you can see right here. And so basically all that just shows on a line where each of the companies stand, and they're color-coded. And then with the OpenAI as one of them, it'd have a high beta. So it's because AI isn't established yet. We just want to throw that out there. So now we move to our implement, which is where we went into our Google Gemini, and basically I had it walk me through the whole driver framework. I was using it to assist me on the way, and I developed it. And so I had it write me a code using the CAP-M formula to write it. So as we see here, we have each of our company data as well as their betas. And then we have just the basic calculations. And then we get down here, and we can now see the coefficient, which is just our required return on investment. So we can analyze this data right here. First scenario 1, which is just the first initial ones. So we have Cloud Tech with a beta of 1.8, and its required return is 15.30, which is actually high because the beta is high, and we'll see this as we keep going down. So regional bank 0.9 beta gives us a required return of 9.9%, which is less than cloud tech but more than green energy, because green energy has a lower beta of 0.5, which the required return 7.5. And then as we see here, OpenAI's beta is 2.5, so the required return is going to be pretty high, and it is 19.5. And then so it gave us a second scenario here, which this kind of gets into the, if I can find it, this kind of gets into the evolve stage, which is what happens if like the return or the risk-free return goes up. So we now see that all of the required returns go up with that risk-free return going up. So it went from 4.5 to 5.5. All of them are going to move up 1% from that. So that's our implement stage. We got it there. And then we have our summary of that, which is just that Cloud Tech and OpenAI have their high betas because of the vulnerable changes. And then the green energy has the lowest beta, so it's going to be less sensitive to market changes. And then all the companies move with that 1% of the risk-free rate when you increase it. So now we're going to validate this, and we're going to show why or like what CAPM misses, because we want to validate that CAPM is accurate, but it has its limitations and you shouldn't only rely on that. So it doesn't take into account liquidity risk, which is just that since Cloud Tech and OpenAI are less liquid than the S&P 500, it's going to be more risky because you can't just demolish the business and liquefy it. And then the size and stage risk, CAPM is best for large, mature companies. So doing this to small premium companies like Cloud Tech, you're going to have to kind of account for that, and it's not always going to be 100% accurate. And the unsystematic risk, which was our OpenAI, it ignores that AI could have like breakthroughs and stuff like that. So with the evolves, the market conditions that change the required risk, the three scenarios is the risk-free rate. If that increases, then all of them are going to move with it. Let's talk about a recession. That's where all the ones with the beta that are relevant to the market are going to move with the recession. So everything's going to go down. The stock market's going to crash. Everything's going to crash, especially the ones with the higher betas. And then finally with AI, let's say AI has a huge breakthrough. We don't account for that required return because we aren't counting on AI to break through rapidly. We see a steady increase with it, but we don't see it rapidly. And then finally, let's just reflect on everything that we learned and went through today. So what's it reveal, what's it miss, the CAPM. So the pros I put is it's good at analyzing the market-wide risk, which it can tell how a stock's going to move with that market-wide risk. But contrary to that, a con of it is the internal risk. It doesn't account for stuff that happens internally within that company. And then another pro is the sensitivity to the market, so it can tell how it's going to move with that market. And then it's good for evaluating big firms because you can liquefy it. There's a lot of public information out there about it, stuff like that. And on the contrary, it's not very good at the cons of it because the private companies can't be traded, so it doesn't really know how traders would react to stuff. And then finally, the last con is that it's only as good as its input. So if you're getting bad information, finding false information out there, you're not going to have good results with the CAPM. And then Just some side notes. My coding went really well today. I think Friday's class helped a lot. There weren't many of us in there, but the ones of us that did go, we kind of learned how to take that next step with the driver framework and really improve our work. I feel a lot more confident with this session, so I'm hoping my grade reflects that as compared to my last grade. And then these are just the last questions that we asked to talk about, which is just that their betas are different. It's kind of miscellaneous work that I did that's down there. But yeah, so I really hope that you enjoyed this video and that you could tell that Friday's class did help when we're trying to make this not only a mindset, but we're trying to put it in action too and act like we're in the shoes of a venture capitalist for this one. So thank you. Hope you have a great day.